So we had a double whammy. Inflation has hit 5.1%, which is absolutely massive, the highest it's been for more than a decade. And then following on from that, the Bank of England have decided they are going to increase, in fact, they have already done it, increase the base rate of interest from 0.1% to 0.25%. So this very quick video is going to take you through exactly what that means for you, at least in the short term, and what could be coming next. So let's talk about that inflation rate first of all. 5.1%. Massive compared to in the summer when we were around that kind of 0.6% and then coming in slowly, getting higher and higher and higher, really sort of shooting up now. This basically means that the amount of it costs for our everyday essentials is basically a set basket of goods that's kind of analysed, and then that's what they kind of compare prices to a year ago. And it's not just stuff from the shops, it's also things like your energy bills, your petrol prices, and they are kind of the big things that are really putting prices up for us. They're the big drivers for things that we pay, but also making the costs of everything else more expensive, because whether you're making food or making goods or transporting stuff, whatever it is, all your costs are going to increase as well from that kind of fuel and energy cost. Obviously, it's other things in there as well, but that's basically where that's coming. So inflation, very high. Things are costing us more money. Now, all we can do as individuals with that is to, try and find ways to kind of bring down those costs here and there. So if it was energy bills, try and have the heating on less, wear more jumpers, things like that, keep doors closed, make sure things are kind of insulated, all that kind of stuff. Using less energy is the only way to bring your energy bills down right now, because the bills are so high and likely to go up even more next spring. Things like food, well, could you try things like the supermarket, maybe shifting down supermarkets? You'd love going to one place, but maybe one of the discounted ones is going to be cheaper for you, or maybe it's going off from branded cornflakes down to own brand, supermarket's own brand cornflakes, things like that. All those little things, okay, we're talking about pennies and pounds here, but that can all add up, particularly on the stuff that we're doing all the time. That's kind of what we're doing, what all the individuals we can do to combat inflation. Not really much else we can do, really. But this is where the Bank of England have stepped in, because they don't want that inflation to keep increasing, because obviously the more things get more expensive, the more problematic it is for everyone. So that's why they increased the base rate of interest. Now, this base rate of interest, okay, gone, as I said, from 0.1% to 0.25%, that's actually a relatively small increase. Yeah, it's not a massive change, but it doesn't mean this is the only one that's going to happen. We could see more of those, and we could see these increases happening more and more over the year. And the reason these increases happen to try and combat inflation, that's why this has happened, is because the idea is if interest rates are better, we're more encouraged to save money than spend money, and that might hopefully bring prices slightly back into check. Obviously, it's not going to make any difference to some of those kind of things like energy bills. That's all happening all the way over there. We can't do much about that. But potentially elsewhere, it might do it, because if inflation is high and interest rates are low, then people might go, well, what's the point of saving? If I'm getting absolutely nothing on my money, I may as well go out and spend it, and that in turn can boost the prices up a little bit as well. So that's why they've made this decision. So what impact is that going to have on us in the short term, at least? As I said, it's a small amount of an increase. So we probably won't see too much of a difference in our pockets right away. Again, that could change if we see more of these increases happen. And there was an expectation that these increases would be sort of gradual over the next 12 months. But you can never predict with this. So, on a week ago, the expectation was interest rates weren't going to go up this week. Then everything's happened with Omicron. They've gone, oh, hang on, no, we are going to. And it was a huge 8-1 majority decided to increase the rate this week. So we don't know next month, the month after, will it go up again? Could maybe in a few months. Everything has changed. It's so unpredictable right now that maybe they bring it back down. You really don't know. But the expectation is it will continue to get higher. But this 0.25%, this 0.15% increase to 0.25%, what does that actually mean for you? So a few things. Savings. Now, you might think this is positive, right? Because if the base rate of interest set by the Bank of England goes up, then all the other banks will follow. And they could, and they probably will at some point, but not necessarily straight away. So I wouldn't get too excited yet as a saver. We might see one or two institutions giving us a little bit more money, but not many of them will. I think we're still going to see pretty poor rates, particularly when you compare it to inflation. Even let's say at the moment, time recording this, the best easy access account is 0.71%. Inflation is at 5.1%. That's a massive, massive gap. And even if let's say they pass on that 0.15% increase and we get 0.86%, maybe even 0.9, maybe even 1%, which would be a massive increase in what we've got right now. Even if they passed all of that on and a little bit more, you can tell that's still a huge difference, a huge way along from actually matching up with inflation. So It's not, if increases come along, I don't expect many places to actually pass this on in the short or medium term. It's still not going to make a huge amount of difference. However, what you should be doing with your savings is not thinking, oh, hang on, I'll wait. I'll just leave my money where it's sitting and hope that the next interest rate rise comes earlier than expected. Maybe it could come next month and it goes up to 0.5, maybe 0.75, and all those things. Just make sure you are looking for the best place right now for your money. Now, I do an update every single month here on the channel, which takes you through the best accounts. And also every single week, every single day, I'm updating an article over on BeCleverWithYourCash.com, my savings best buy article. So that will tell you the places paying the highest interest at the moment. And any changes that do come along as a result of this base rate change, I will be updating it there straight away. But again, I don't expect too much, but make sure your money is in the best place it possibly can be for now. I would also hesitate, I've mentioned this before on those regular updates, I would hesitate about locking your money away for too long if we are in a position where interest rates are going to increase, because you've locked your money away for, let's say, a year in a 1 year fix, or 2 years, 3 years, 4 years. Certainly we're avoiding 2, 3, 4 year fixes personally. It's up to you, obviously, because then if we do see a more dramatic increase in rates and eventually the banks do catch up and offer us better rates on easy access, your money's locked away and then you're actually potentially losing value. So I would stay clear of that. But again, you've got to weigh up whether you want that security or not. So that's interest rates. Kind of, not good news, not bad news, potentially edging us towards good news, but still right now, nothing really to shout about. Where there will be bad news is from anyone with a mortgage that is on a variable rate or on a tracker rate deal. So these ones basically can change at any point. So a variable rate one will change whenever their banks want them to. And essentially right now they'll be going, right, let's lift it up. Let's move it up. Okay. And not all of them will, but a lot of them will. They'll move up that variable rate. So if you're on that, you'll probably start paying more almost straight away. They might give you a bit of notice, but generally it can be happening very, very quickly. Likewise, a tracker rate one. This is where you might get a deal that's, I don't know, let's say 0%, 0.5% or 1% plus the base rate. So in fact, probably higher than that. That'd be amazing deals if you had that. But let's say it's 1% plus the base rate. Well, all of a sudden you're paying an extra 0.15% on your payments. Now, that might not be a huge amount for you every single month. It does depend obviously on the size of your mortgage, how much money you've borrowed. But again, that's something to bear in mind. If rates were to increase again and again, that rate could start getting higher and higher and higher and higher, and you will be feeling that straight away. So whereas your savings probably aren't going to be boosted at all, your mortgage repayments will be. Now, if you're on a fixed rate, then you are fine. That is not going to change, at least for the duration of the fix. But what it does mean also, if you're in a kind of the process now of looking to remortgage or looking for your first home, those best deals, which we've seen over the last 3 or 4 months, those really, really low deals, they've already started to disappear. And I wouldn't be surprised by the time I finish recording this, they've already gone. Those rates are much higher. So sadly, you would have missed out on some of those options. I wouldn't, if you're thinking, oh God, no, maybe I need to get on this, have a look. You never know. There might be 1 or 2 that are still lurking around, which are decent. You might be able to get an application before they're pulled, possibly. So definitely have a look at that as soon as possible. But it's not kind of go, oh, damn it, too late, I've missed it. Because if there is going to be another increase, and again, that could be 0.25% next time, who knows what it might be, up to 0.5%. Again, it's going to go up more. So it's definitely worth having a look at that as soon as you can. Now, in terms of other debts you might have, credit cards or loans or things like that, again, they are likely to be unchanged because they're generally fixed at a certain rate. Although credit card, as I mentioned in my credit card update the other week, a lot of credit card companies Amex, for example, are increasing their interest rate next month. But hopefully you're not paying any interest on your credit cards. This is one of those things that you're using to take advantage of consumer protection or cashback and things like that. And you're clearing that balance every month, so avoiding that interest. And if you've got a loan, that's going to be like, a 2-year loan, 3-year loan, whatever it is, at a fixed rate. That is not going to change unless for some bizarre reason you've got one that can change following the tracker rate or something. But most loans are going to be fixed at a certain amount of time for a certain rate. So you should be okay there. So a quick summary of what's been going on then. Inflation now 5.1%. Goods are costing us 5.1% more now than they did a year ago. And that well could continue. That could continue to get higher and higher and higher if measures such as trying to increase the base rate of English interest don't bring that down. That rate, as we said, has jumped up from 0.1% to 0.25%. Hopefully, a glimmer of hope for savers there that rates will improve. But again, it's not going to happen straight away and not by a huge amount of money, especially when compared to inflation. And bad news if you are on a variable rate or a tracker mortgage because your payments are going to be getting more expensive straight away. My name is Andy Webb. Thank you so much for watching. Here are a couple more videos you might find useful.